Recession. What is a recession? It's important to understand this term before we try and figure out strategies to mitigate it.
Economists define a recession as 2 consecutive quarters of decline in a nation's GDP, gross domestic product. In simple terms, a recession can be defined as a significant, widespread, and prolonged downturn in economic activity. Hi guys, and welcome to our channel, Practical Finance, where we cater to your day-to-day financial needs and wealth generation, ensuring sustainable growth and a secure future for you and your family. Now, we must look at some major reasons causing a recession and how they are closely linked to consumer psychology, which in turn affects day-to-day financial decisions. The first reason is a loss of confidence in investment and the economy. This reason itself is a combination of many smaller factors. Loss of confidence compels consumers to restrict their buying and move into defensive mode. This creates a situation where demand from the consumers fall, and, as a result, production falls. Lack of production means fewer jobs created and/or current jobs lost, leading to a further fall in demand as the consumption power decreases. Retail sales slow. Manufacturers cut back in reaction to falling orders, so the unemployment rate rises. At this stage, the central bank of a nation eases the monetary policy by decreasing interest rates, so people will more likely spend, or the federal government steps in with the sister policy, that is fiscal policy, by either spending itself or printing more currency and distributing it to encourage more demand. The challenge with government intervention is that once the government enters, it starts to take the responsibility of fixing both the supply and the demand side. With high levels of inefficiency in most governments across the world, intervention leads to more problems. Guys, if you are interested in a more detailed economic analysis, make sure to comment. The second reason is a real change in the economic fundamentals. What we mean by that is, imagine the current geopolitical situation in the world with Ukraine and the latest Taiwan conflict, and the COVID epidemic before that. These challenges can disrupt supply chains, leading to a halt in productivity. Shocks that impact vital industries such as energy or transportation can have such widespread effects that they cause many companies across the economy to, well, you know what happened in reason 1. Another important reason is the market rates, which are often artificially suppressed by a nation's central bank to keep demand high and the currency more competitive. When the production side falters, the monetary policy fails to respond, as the monetary policy becomes ineffective. FYI, a fall in GDP is not always a warning for recession. It can easily be an indicator that recession has already set in, the reason being that GDP calculations are done every quarter, and by the time the latest data comes out, the economy is already in recession. Now, we have a pretty fair idea about inflation and the reasons responsible for it. It is time to see how we as everyday people can protect against it, and if we play our cards right, how we can even profit from a recession. Let's look at the 3 strategies now. The first strategy that we will be talking about is to use the dollar cost average when share prices decline. Now, what in the world does that even mean, right? Simply put, it is the practice of investing the same amount of money at regular intervals, regardless of the security price. This helps to mitigate the overall price volatility and lower the average cost per share. We will give you a practical example to explain how that works. Imagine investing $1,000 in a mutual fund priced at $25, that gives you 40 shares. Now if the price drops to $20, your contribution will buy you 50 shares, your account now has 90 shares with an average cost basis of $22. As the share price drops, your $1,000 contribution buys an increasing number of shares and your cost basis continues to drop. When share prices rebound, your contribution buys fewer shares each month, but the current share price is always higher than your cost basis. Pro tip here is, if you are going to hold stocks during a recessionary period, the best ones to own are from established, large-cap companies with strong balance sheets and cash flows. The second strategy we will discuss will be to buy into dividends. For most investors, dividends serve a multitude of purposes. Firstly, if a company has a long history of paying and increasing dividends, you can have peace of mind that it is financially sound and can survive most economic environments. Secondly, dividends provide a return cushion. Even as share prices decline, you still receive a return on your investment. It is for these reasons that dividend stocks tend to outperform non-dividend stocks during market downturns. The best way to own dividend stocks is through mutual funds or exchange-traded funds that invest strictly in dividend-paying companies. Funds that invest in companies with long histories of paying dividends and strong track records of increasing those dividends tend to generate high current yields with capital appreciation. pro tip here is to bear in mind that these funds are not there to outperform the markets during a rebound. They are held in portfolios as a defense mechanism against changing market cycles. You should during a market boom allocate away from dividends a little bit, but always maintain some for emergencies. The third and final strategy sounds fairly obvious and is obvious but is often neglected. It is to invest in consumer staples. Even during recessions, consumers need to buy the essentials like food, drugs, hygiene products, and medical supplies. These are called consumer staples that are the last items to be cut from the family budget. So, while companies selling flat-screen TVs and other discretionary products experience drops in revenue, companies selling food products and other necessities do not. Because of this, consumer staples companies are sometimes called defensive stocks, since they tend to remain resilient even when the economy falters. Data shows that these types of companies outperformed the S&P 500 during the last 5 recessionary periods. Consumer staple companies include Johnson & Johnson, Procter & Gamble, Conagra, and Walmart. These particular companies also pay good dividends, which strengthens their defensive profile. There are also mutual funds that invest strictly in consumer staple companies. The Fidelity Select Consumer Staples portfolio invests a minimum of 80% of its assets in companies engaged in the manufacture, sale, or distribution of consumer staples. Now, having learned what recession is and the 3 best strategies to undertake during a recession, we hope that you will be equipped with a better understanding of the whole situation, and find yourselves in a better position to deal with the crisis. For more such interesting and practical videos, make sure to like them, and please subscribe. Also, comment down below on what other topics you guys would like to watch the videos about. Take care of yourselves and your families. God bless us all. Thank you.